What are your comments to the suggestions of Hans-Werner Sinn?
First, let me thank the organizers for the privilege of coming and discussing with Hans-Werner Sinn, who's an old friend. I have enormous respect for his work, and I do recommend his book, The Eurotrap. It's based on careful research. Nevertheless, I have serious disagreements with Hans-Werner. Let me go back a little bit further to the origins of monetary union to explain why. Why did we get monetary union? I think Germany did not ask for it. The French asked for it primarily, the Italians as well, not the Danes. We thought, in fact, that Germany would find it unpalatable because they had the leadership in the previous system. But in the end, Germany was persuaded, to the surprise, I think, of many politicians in Denmark. That may be one explanation why we did not join the euro in the first place in 1992, where we reserved our position initially. But Germany had a couple of strong arguments, which were broadly shared by others. German industry, German labor unions wanted stable exchange rates in Europe, wanted stable competitive positions. They were not afraid of a strong Deutschmark, but they were worried about the sudden changes that could happen and the fact that that could totally undermine the single market which was under construction at the time. Also, Germany was tired of being the European spokesman globally, being bashed around by the United States. It was seen as creating a more solid structure to have a single currency. So Germany accepted in the end. The French tried to persuade them initially to do it on a bilateral basis. The Germans were unsafe about that. They said, we want a broader basis, a European basis, and we'd like some allies in the club as well. They thought of the Netherlands and Denmark, I think, at the time, but we were not responsive to that challenge. So it started, and Germany, there were always two basic concepts that came up when I visited Germany prior to the start of monetary union. One was the Stabilitätskultur. Germany saw that finally they could export some of the stable policies that they were in favor of in the 1970s and 80s relative to others. And secondly, there was what they called the Schicksalsgemeinschaft, the community of fate. You can say that both of these concepts never quite penetrated in some of the other countries in Europe, and certainly not in France. And that is, I think, at the root of the problem. So I understand well Hans Werner's and other Germans' frustration over what has happened in Europe with this project that was meant to be a promising enterprise. Germany did not follow up on these, I think, concepts for a number of reasons. Mainly German unification took away all the attention. Chancellor Kohl, who had a lot of goodwill for Europe, did not really discuss these issues sufficiently in Germany. So we've gotten that discussion much later. And Germany was much weaker at the time. So Germany, in fact, pushed for lower interest rates in Europe. But Germany has a certain responsibility for the way the euro started. And of course also when Chancellor Schröder was there, for breaking the rules that Germany had insisted on so strongly. So Germany did not set the good example finally for the Schicksalsgemeinschaft that she thought she would. And then we get, of course, into the crisis period. I agree with you that the euro contributed to the boom, the boom periods in parts of southern Europe. But the euro was not responsible for all the problems. They would have happened, they did happen in a number of other countries as well. And I think you are also since seeing the euro as too much of a part of the problem, you put too much emphasis on the issue of competitiveness and too little on the balance of demand within Europe, too little on the, in economist terminology, on the macro aspects of Europe. I used to come in, still do in Anglo-Saxon environments where the criticism is just the opposite of what Hans Werner says, that Germany has also a responsibility by building up a massive surplus of 7%. It would not help maybe Greece, certainly not, but maybe some of the other countries. It would certainly help some of the northern European countries if Germany had a more expanding economy, but that is not in the cards. And my own solution, in contrast to the three that you proposed, is not to go back to something like the exchange rate system we had before. That would impose massive transition costs to go back to the EMS. That's basically what you propose.
No.
In the last 2 points, a holiday from...
I still want...
a holiday from the exchange rate system and the settlement of the target balances, as we used to have in the EIM, where central banks could give credits for 3 months, and then you had to repay. So you knew that policies had to be corrected fairly soon. That doesn't exist anymore, but the cost of going back to that system would be massive, not only in Greece, but in a number of other countries. I don't think you consider those transition costs sufficiently. And you're too critical of the ECB. What should they have done, in your opinion? Should they have said to the politicians, we're not prepared to do anything, you have to do the whole process? Or should they do as they have done? We give you a little bit more time to prepare for the structural adjustments and policy adjustments that are required for the longer term. That is really my basic question to you.
Do you think the ECB could have done otherwise?
Not entirely. I'm not arguing that the ECB was always wrong. For example, I fully endorse what they did in 2008 and 2009. That was a sudden stop, a sudden liquidity crisis, and they had to intervene. For me, these kinds of measures are like for a person with a heart problem who once in a while has to chew a nitroglycerin capsule. Yeah? So I accept that there are situations of that sort, but you cannot chew that all the time, and then it becomes dangerous, and that's where we are. So my criticism begins in the autumn of 2009, at the latest 2010, when there was this enormous boom in the world economy, and the ECB did not exit from its emergency measures. Then it became a bailout. It became a credit operation for the purpose of rescuing states and banks in Southern Europe, something which should have been, from a legal perspective, decided by the parliaments of Europe. How can it be that the ECB commands credit in the order of 1,000 billion euros, when at the same time the fund of Mr. Regling has to deal with a couple of hundreds of billions of euros as a potential, and actually he gave out much less. So there is something wrong. The governing council made all these decisions which are fiscal in nature. They could have been right. Maybe it was right to do it, but then the parliament should have backed that up, and not the council.
The parliament didn't back it up, and Germany couldn't do anything, it seems, or they could have done something. There's an underinvestment right now in Germany, but I would like to have the basic question about, should we have a more expansive financial policy in Europe, or a more monetary solution to this, or are there third options, Philipp Schröder?
Well, it's, first of all, it's quite difficult to disagree with the analysis that we have just seen, but in a sense, there's maybe one area where it misses the point, because much of the European growth problem has been present before the euro. So I think we have a persistent gap of about 1 percentage point productivity gap to the US from early 90s onwards. And you just made the point that were already credit misallocations that could have triggered part of that. And I agree that is a conceivable explanation, but it fails to recognize that our real issues, if we look at growth, are in what we would call structural policies. We have so much headroom still in Europe to adjust structural policies, ranging from the way we organize competition, from the way we trade internally. I don't know if you noticed when Hans Werner set up his computer power outlet, luckily you had a German power cord that would go into a Danish power socket. If you had the inverse problem, it wouldn't work, right? Oh. It takes a lot of force to put a Danish plug into a German power socket, and let alone a UK power socket, right? So, and I think these issues are overlooked because we focus on our textbookish backbone reactions, monetary and fiscal policy, when there's so much room for structural improvements that are unexploited, because we are overlooking them currently. And one of the big growth spurts we had in Europe was in fact the single market program that made a big difference to European economies, and this is sort of forgotten in the current debate.
Some of the slides showed really the need for heavy deflation in some of the crisis in countries, but structural reforms have the problem that they are very slow. And we need a certain amount of speed right now.
I think structural policy is the same issue as the debt conference. As economists, we know which was the big, I think it's a very, very important point in the solution proposal that we just heard. We know as economists that stabilizations notoriously are delayed. And the more players are around the table, the more delayed they get. And that's a classic free rider issue. And exactly the same is happening in the European, basically in these areas where it hurts. Special interests that have to be challenged, public sector special interests, which are at the heart of some of the inefficiencies we see in Southern Europe. It's very hard to tackle these issues, but it can be done. I mean, a single market program, few people would have thought that it was feasible early 80s. It was feasible. So why shouldn't we be able to have the same push in Europe again?
Okay, Callesen, what could be the role of the central bank right now, or could central banks really help us out of the crisis, and especially the ECB? But being a bit aside of the ECB, you're not part of the conversation there.
The ECB has a mandate, and that mandate is to pursue price stability. And the reasoning behind most of what they're doing, if not everything, is that currently inflation is much below the target. And for that reason, they undertake extraordinary measures to push activity up, inflation back on target. You can dispute whether this is, it's a question of the motive for what they're doing. Is it bailout or is it inflation targeting? I believe it's inflation targeting, and the test is really what would the ECB do if inflation comes back to say 2 or 2.5%. They would do a lot of things differently from what they're doing now. I think that's a basic point. So the ECB is actually doing a lot here. If I allow me a few reflections on what we have heard, and I don't want to leave the impression that everything in Hans Werner's analysis is wrong. I think there's a lot of virtues in it. However, the one basic factor we need to take into account is, was this a currency issue? Or was it bad economic policy throughout a wide part of the euro area and other EU countries? I frankly don't believe it was a currency issue. And just to, the most simple example is if you have the distance from here to say Brussels, I don't think it makes much of a difference if you measure in terms of kilometers or in terms of miles. It's the same distance. So if you use another unit of account, we would have had a lot of trouble in any case. Would we, in the absence of the euro, have had all the wonderful structures and forms implemented? Would we have had a sustainable fiscal policy? Would we have had a counter-cyclical fiscal policy? Actually, I think the opposite would have happened. It would have been quite a bit much worse, because if governments believe that there is a wonderful tool available in the coffers of the central bank, that you can run irresponsible policies, and then the exit option, the devaluation option is available, then they actually get a strong incentive to run their, say, irresponsible policies. And since, as I believe it, it is not the currency which is fixing everything, that can control inflation or contribute to inflation, we will be much worse off than where we are now. I cannot comment on two more comments, I think. There was a slide before that one with the 4 options. I agree with the 4 options, but I don't agree with the interpretation of what we're doing. I think what we're doing now is a combination of trying to inflate the North. It doesn't work because the private sector in the North doesn't want to spend. And we run austerity and deflate the South. That is being done, and it's necessary because they live beyond their means. That needs to come back again. I don't think, however, it's fair to say that we are doing a lot of fiscal transfers or bailouts. Actually, it is not proven that even the German taxpayer has lost a single euro cent so far. That may happen if Greece exits, if Greece collapses or whatever, but that has not happened yet. So the options are right, but different interpretation. On these 3 recommendations, well, the first thing on the debt relief is actually quite close to a fiscal transfer to a large extent, because a lot of what is happening is sovereign lending to these countries, so that might not be that different. I don't like the option. I think it's very dangerous. I prefer the option of having interest rate support, as long as that is actually doable. On the temporary exit, Let's skip the target balances for now. We can come back to that later, I think. But on the temporary exits, I mean, this was a kind of policy we pursued in this country until '82, the fixed exchange rate policy, and honestly, it was not a great success. If that option is available and is pursued, of course, interest rates will shoot up before it happens. If they really go into this experiment, obviously the interest rates would be higher again subsequently. And since they would believe that this is a substitute for the austerity and the necessary fiscal and structural policies, then there's no real reason to believe that this devaluation will be effective, in the sense that we wouldn't have a pick up in inflation subsequently. Thereby, after a limited period, we would have squeezed out the original gain in competitiveness. So I don't have much positive to say about that option.
What do you say, Hans Andersen, because there's really a reflection here, when you have a devaluation, all the savings are just devalued as well, the people are starting to also take the precautions. Maybe it'll happen once more, and they'll have the small parties afterwards, when you get the growth back on track. But then the expectations run like in the 70s ahead of us. How can we tackle this in your exit model, or swift exit enter model?
You mean the people will think they can easily get rid of their debt by exiting, and so they will repeat it?
Yeah, maybe.
Well, maybe they want it, but the creditors would be very nervous about this and would, to the contrary, shy away and charge high interest rates, and that will be the disciplinary effect. So what we are doing now is we have this enormous bailout instead of bail-in, and bail-out means the creditors can run away. So they do it again and again and again. The German life insurance companies again now collect the savings in Germany and again invest in Southern European government bonds, as if nothing had happened, because we artificially create the safety for them. So that's a major mistake. And here I beg to contradict you, express an opposite opinion. Does one really try to inflate Germany? What does the ECB do? It escorts the savings with its OMT program out of Germany. It says to the life insurance companies, please go buy Southern government bonds. Don't be afraid, you won't get your money back. I am there. I will buy the government bonds out of your hands in the case of emergency. So these banks and insurance companies have every incentive not to give the money to domestic users, but invest the money for a little surcharge of a few basis points to other countries. That's not a policy of inflating Germany. The inflation of Germany would have happened automatically had we allowed the markets to operate, because then the investors would have shied away from investing in other countries. They would have invested at home. There would have been an investment-driven inflationary boom in Germany. The current account would be smaller and all that. That's what I find schizophrenic in the EU policy. On the one hand, they say, well, we have to channel the money out of Germany, and on the other hand, they say, well, you don't invest enough in Germany. Now what? What do you want? You want us to bring the savings out of the country or invest it in the country? We cannot do both.
I think they need both. Maybe.
Well, no, that's not possible. These are rival possibilities, and there is an unclear road. Let me just put up some other things here. Was the euro instrumental for bringing down the interest rates in Europe? I would think so. First of all, the exchange rate thing was obvious. The exchange risk disappeared. And the bankruptcy risk was not seen by investors because one could not imagine that under the euro, where everyone had access to the central bank system, a state could still go bankrupt. So it created an artificial sort of safety against bankruptcy possibilities. On top of that, the ECB, the EU interpreted the Basel rules in a particular way that allowed the banks to accumulate government bonds without holding equity against it. In particular, when banks use their own risk model, they would usually have been forced under the Basel rules to hold equity against government bonds. And the ECB ruled that out with a special kind of administrative act, allowing the banks, even in that case, to stick to the general zero risk weight model. And so they were loading their balance sheets with the banks of Southern Europe. If it was not directly the euro, it was at least a policy mistake of the EU. And let me just say a further point. Germany has not lost a cent. Where are you? The low interest policy is a policy that, of course, hurts the savers enormously. Germany is by far the biggest net foreign wealth owner in Europe. And had Germany's accumulating net foreign assets been serviced at the rate of interest of 2007, say, the German aggregate net investment income from abroad would have been 242 billion euros higher. So there is already an enormous loss of savers. The life insurance companies in Germany don't know how to service their contracts. The foundations, which are just able to use interest income and not the capital, have no money anymore. There are obvious losses.
Niels, Thygesen, you asked for a comment?
Yeah, I have two comments on what Hans Werner has said. One is on the OMT, the market transactions promised by the ECB. It's a conditional promise. I think you have overstated today, and when you gave your witness statement to the German Constitutional Court, the OMT is a contingent promise. It is contingent on the willingness of governments first to install a program in their country before they can draw on that facility. And secondly, it's limited to the short end, so it's not so relevant for long-term investors. And you can calculate, in fact, more or less what the maximum is for Germany. That was the main argument in the Constitutional Court, that Germany has to know what it may be implied by the scheme. So I think you are too critical of the OMT. The other problem I would mention is what you say about German savers. It's a surprise, I think, to many of us that the German population finds it acceptable to have a 7% surplus on the current account, which is invested at very low returns abroad. Germany could be maybe a little bit more imaginative. It could have done something else. It could invest outside the euro area if it doesn't want to spend the money at home. So it's, in a sense, restrictive policies on the part of Germany herself. Regulations on the German banks, they cannot really finance banks in other parts of the euro area. That's why the money ends up in the target system. And the insurance companies and the pension funds cannot assume exchange rate risk. So there are many restraints in Germany that prevents it from playing the positive locomotive role it could play without overspending at home, without even changing its total budget deficit.
Philipp, yes?
I would like to get back to the devaluation point, because it's a magic bullet in the solution. The three-point solution plan is, of course, the devaluation. And if you recall the discussion we had on austerity and the pains that inflicts on society, and basically that people eventually throw stones on the streets, I'm not sure that the devaluation, a temporary exit, is much more pretty. Because it immediately means that the old age pensioner has to pay more for their heating. It means that we always envisage imports as being goods for private consumption. The lion's share of all the imports in Europe are products for production. So it wouldn't necessarily improve the competitiveness of the South if they devalued, because these firms are dependent on imports. And so it's still a mixed blessing, but it might be less painful than the austerity. But a thing we haven't thought about, which is a conceivable solution, is, of course, and which is a real cost that we saw in the first couple of charts, is unemployment. I think it's amazing that Europe is currently wasting entire generations of capable people not working. And a person not working means we're losing GDP. That's as simple as that. So that's the only thing that produces GDP is machines plus people. So if they don't work, we have no growth. And one of the grand solutions, of course, to have people move. And we don't see enough of that in Europe. Of course, if unemployed, talented young Spaniards or Italians showed up in Denmark or Germany to contribute, where there maybe is a capital, where there might be the demand, it would be a very different economic situation, and we are not exploiting that sufficiently in Europe.
Yeah.
As Werner is obviously correct. Hans Werner is obviously right that the introduction of the euro was the main factor behind the low interest rates we achieved. However, that was an opportunity missed, that's my point. It was not a real relief Italy got from cutting the interest rate on government financing, because the erosion of public debt was accordingly lower, because there was any longer any inflation to erode the size of public debt. So that was a misinterpretation. It was bad economic policies. But remember two things. This was not only in certain euro area countries where economic policies was completely mismanaged over the 2000s. It was other EU countries. It was outside Europe. The second is financial markets were asleep everywhere. It's true that the argument can be raised that financial markets might have punished Greece and others at an earlier point. Unfortunately, they were asleep also when it came to subprime emerging markets elsewhere. So I'm not completely convinced.
And they're still sleeping in some way, you know. Some of the toxic assets are still there, you know.
Yeah, the financial markets buy stuff. I think they have learned some lessons, but memories are often short. True. If you can make two more points. The one on the German taxpayer, I think Bundesbank have made the calculation that accumulated since 2008, there's been a savings on the interest payments by the federal government of some 125 billion euros. That's a lot. I accept the argument that German savers have gained less. But how much is that really due to the ECB, given that the overall international interest rate environment has come down very substantially? That's also part of the savings for the German government, of course. And I wonder, even in the absence of central banks, if the private sector across the world, everywhere, insists that whatever the return, we wish to have financial assets. And remember that any financial asset is somebody else's debt. But if that's what they want, they get no return because the interest rates are zero, then you get this kind of vicious circle where the financial markets are competing the interest rates to a rock bottom level. Yes, the central banks have assisted in that respect because they want to push up inflation to their target, but they are certainly not the only ones responsible for that.
Yes. Okay.
Yeah, so the low interest rates have many reasons, of course. It's not only the deliberate policy of the ECB, but it includes the ECB's low interest policy, which has obvious losses. Of course, the German government gains, but that's only part of Germany. If you take the entire Germany, it is having a current account surplus that is exporting net savings of 200 billion per year, including the government, including everything. So, and the net foreign asset position is 1.3 trillion. And if you reduce the interest rate, you have a direct loss of the interest rate reduction times the 1.3 trillion. This is net and aggregate, including the government over everything. This is obvious. The debtor gains if the interest rate is low and the creditor loses. The losses are being hidden. You know, the losses do not show up in terms of write-off losses because before you really write off something, you give a new rescue credit to redeeming the old rescue credit. It's a situation like a bank being confronted with, say, a local bank in a small town being confronted with a local employer who is writing red numbers. And they have given a loan, the loan expires. So what can you do? If you do not roll over this debt, then you have to declare the losses in your own balance sheet. The employer is bankrupt and you're bankrupt yourself. So the manager has every incentive to give a new credit to tell his owners, well, there's not a single cent which we have lost. And so he rolls over the credit until he retires and the job is taken over, and then the new manager tells the truth. The OMT program, this is, I think, essential, Niels. The program yes, requires that countries are receiving funds from the European Stability Mechanism, Mr. Regling's fund, so there is a democratic control, but it is safety for investors, because take Spain. If I buy a government bond of Spain, Spain is not part of the program yet, but before they would go bankrupt, there would come a period where they are in difficulties, where they would go to the fund. And then the ECB would be willing to buy the government bonds of Spain. And you say it's only short-term maturities. No, it's not only short-term, it's also long-term maturity, because what they say is the remaining maturity until the remaining time until maturity is 2 years. So every long-term bond will come into this phase where in the end there are only 2 years. So every single government bond is eligible for the OMT program. So it's a perfect safety, and the ECB has declared that it gives up its priority status in the case of bankruptcy, and is on pari passu status with private investors. So it really put the taxpayer on the hook, and the taxpayer who is entitled to receive the profit distributions from the ECB would in this case bear the losses because he would have to compensate the national treasury.
Yeah, I'll just give you a small comment, and then I'll invite for questions from people out here, because I think people also want to raise questions. Okay?
A warning, there are probably a couple of people in the room who can understand the discussion on target 2 imbalances, but let me just it's not, I will not just discuss target 2, but let's make an example, because Werner also indicated that the issue politically, which is understandable, relevant for Germany, is not only the government, it's the entire country. But let's try to assume a bit what is the counterfactual. And let's assume that what happened, to start as an example, German banks provided funding to Spanish banks. These Spanish banks, they lend money to the construction boom. That was basically what happened. So let's assume now that we didn't have the euro. If in the absence of the euro, the Germans would have lent either Deutschmark or pesetas to the Spanish banks. When they wanted their money back, then the Spanish banks has no other option than to go to the Bank of Spain, provide their collateral, and they would have been refinancing operations and provided liquidity from the Spanish bank. That would not have been everything, because due to the huge currency outflow, the peseta would have collapsed. Now, that can, if the Germans have lent in Deutschmark and a collapsing peseta, that would have implied that the Spanish banks and the construction dealers, they were gone bankrupt. That would also have contributed to losses from the German banks.
Anyway.
They did anyway, to some extent. It would have been much worse. Now, if they had provided loans in pesetas, and the peseta would have plummeted, say, by 30-40%, then obviously the same thing would have happened. There would have been a huge loss also for the entire German economy. So in that sense, the existence of the euro has not solved the crisis. It cannot solve the crisis. It's not a currency issue, but it actually contributed to some stability, gaining time, enabling countries, both in the north and the south, trying to adjust themselves out of the mess they created for themselves, which of course they shouldn't have done. I mean, my main recommendation for economic policies is that, well, I wouldn't start from here. I would have done something very differently.
Of course, there always. Please, somebody out there, I know there are several economists even here, so please, someone to raise a question? No. Oh, yes. A short question, please.
Lars Ekkel. Don't you forget the political and historical angle of this? What happened 25 years ago? We learned this morning from the news, Philipp and Niels speaking about what happened, and also that the condition for Germany to be reunified was to give up the Deutschmark and have the euro instead.
Okay.
No, of course not. I agree that this was the reason why Germany accepted this French wish to have a common currency. Germany, I mean, it might have happened without that. So some people say coal was determined, but I'm convinced that Mitterrand's agreement to the 2+4 negotiations was at least a triggering event, helping Germany to say yes to the euro. Yes, indeed. I don't, but something is in the background of your question, which makes me a little bit
Your
hesitant.
responsibility as a German.
Yeah, well,
Something like that.
I'm not taking a German position
No.
here. I mean, I take a position for the construction of the whole thing. I think it is inefficient. It is not working, the whole thing. And the greatest victims are not the Germans. I never said that. The greatest victims are the poor people in Southern Europe who are now unemployed. Yeah, and we fully agree on that. We sacrifice one generation of Greek people because of an idea.
So should we make a debt conference, like he suggested?
I think Greece had her own currency a long time, and she devalued a couple of times in the 1980s. Didn't solve her problems. Spain had her own currency. They also devalued. They had twice 25% unemployment in Spain before the euro. They managed to reduce it after that. But it's a tragic, I think, reflection on European politics that we have to be in such long crisis to have any meaningful reform of labor markets, for example.
Yeah. Okay.
If debt relief is a solution, I don't think so. Actually, there has been debt relief to quite a large extent in Greece, and they get an implicit, as Werner has explained it, huge support for their interest rates, which, by the way, is not necessarily costly because this is money raised by the European institutions at markets, and they pay that market value, so they get a lot of support, liquidity support. That's helpful. But I mean, debt relief is an extremely complicated thing. As I mentioned, it's not that far from fiscal transfers if you go further down that route, because the remaining Greek debt is all in the hands of foreign governments, so it's very close to fiscal transfers. And introducing this kind of debt relief over time is also not very far from the devaluation cycle you introduce. It's moral hazard of probably the worst kind you can imagine, because then you start buying something. Eventually, when you buy something, you're often faced with a bill. You have to pay for it.
Okay, another question?
I think there's so much to say, but talking about history, shouldn't we talk about before Lehman Brothers crisis and after?
Let's talk about the future today.
Let's talk about the future. Okay, I have a suggestion as an economist engaged in policy, and I've written it down, because I can talk for a very long time. What about a new mandate to both the states and a little bit more freedom to the central banks, with more focus on unemployment, which I think is an enormous social and political risk in the South? I would say a new, I wouldn't mention but you can see Greece, new fascists, new nations, or whatsoever. More focus on the unemployment risk and more national freedom to both the central banks and the states.
Okay.
That's my suggestion.
Yeah, well, we have to fight the unemployment, but certainly not through the ECB's lending even more to these countries. I mean, at best what you can create is some artificial demand out of this new money which you provide, but that is not a replacement for the international demand for Greek products and services, which would only come if they are cheap enough. We cannot avoid the devaluation, and these measures just postpone the necessary devaluation. The more money you pour into these countries from the ECB, or allow them to borrow in the market with common promises with regard to the creditors, the longer it will take to carry out the reform. Why should they carry out the reform? When we had the problems in Germany 10 years ago, and Schröder did his Agenda 2010, he did not do it just because he liked it so much, because the unions saw no alternative. Everyone understood there was no way out. They were cornered. And so in the end they had to do it. Only under enormous pressure will such painful social reforms take place, not if money is there.
Short comment?
No, I agree with Hans Werner. And remember, when central banks do inflation targeting, they implicitly, what they are doing is actually keeping the economy at its potential. Because what is driving inflation? That's the deviation between the potential and the actual output, including not least unemployment. So if unemployment is very high and it is cyclical, not structural, then you have low inflation. For that reason, the monetary policy becomes more expansion. And that's actually what is happening for the time being. And it's not an argument that central banks are targeting unemployment. They're not. They're targeting inflation, but it is actually supporting the economy. That's what central bank stability can do for the economy.
Philipp, just as a brief reminder, I very much agree on your remarks, because it's monetary expansion or fiscal expansion itself doesn't create economic growth. It is, in the end of the day, it is being hands-on machines that create growth. In that respect, what drives that, what is generated, what then creates the ability to create growth is the productivity in the economy. And I guess the misallocation argument that we had earlier, that we have systematically channeled investments to areas where they're not efficiently used, is of course a contributor to the current productivity crisis we have in Europe, and accordingly the growth crisis. So labor is half the story, the other half is productivity.
Okay, question here. Chris?
Thank you very much. Yeah, I agree with some of the things which Hans Werner Sinn said in a very brilliant manner, with beautiful diversity and so on and so forth. But first of all, I think there is a kind of, well, there are things that he did not say, but which are implied. There was a rosy picture, somebody said it already, a rosy picture of what existed before. But before, there was already a crisis in Europe. There was already an absence of competitiveness from the southern countries. And the euro has given them chances to go ahead. Of course, they did not take the chance, and they were, I agree, there are some things which are not working in the architecture and so on and so forth. But we have to do it. You criticized one after the other all the proposals, but maybe taking a little bit of each. And your solutions are also not very well. I agree totally with the criticism about going from time to time outside and coming back. And the most important thing I want to say, it is a political matter. Whatever the economic factors in that fact, do not prevent that if politically the heads of state and government of the 28 members, and especially of the euro, but of the 28 members, agree that the euro is here to stay and will make anything to do it and to work for it, it will be done. Because what you said about the ECB, acting not democratically, but I think you said that the parliaments would have reacted. They did not like what ECB did. And the heads of state and government would have also done that. So I think we should not exaggerate first, there was a picture of before. Second, not forget it's a political thing. And three, it's done under democratic control. Thank you.
Okay.
No, well, the ECB decisions are not done under democratic control. Definitely not. The ECB is independent, and there is even the claim that it not only acts independently within the mandate it has been given, but interprets the mandate itself in a very extensive way. That is the position which the German Supreme Court has taken. It has said in February, after checking the conditions, that the ECB has overstepped its mandate and it has misused its power. And it has also said that the German government is not able to tolerate that, close its eyes, but has to actively operate against it. And if it doesn't, each German citizen has the right to sue the German government. in front of the Supreme Court to make it act. You know, I'm not a lawyer, I'm just citing.
It's not complete.
It is not yet a sentence, it's not a formal ruling, but it had 60 pages in which it explained its own opinion very clearly. And this is why the German government has been now very restrictive with regard to the ECB. The ECB also has to react to that and take that serious, because in the end, the court is very powerful. It can force the German government and the German parliament to take actions.
Okay. No. You have a lot of time to speak afterwards. One question, last question, and then we'll finalize. Now, yes.
My name is Andreas, I'm a journalist. Going to something very concrete, you're talking a lot about ECB being a principle and what it should do. And what we heard now, Draghi say is that he's going to expand the balance sheet with 1 trillion euros. And I just wanted to hear your takes on how that's going to happen and what the consequences will be.
Well, he wants to go to quantitative easing, and he has begun by buying covered bonds, and now also is preparing ABS paper. If the ABS paper was of the highest quality, I think one should accept it. But he has already declared that he will buy ABS papers, that these are composite credit claims which banks hold against or make out of claims they have against their clients. So it has already declared that it will accept less than BBB minus, and it has also said it will follow the collateral policy. So it has already a system of collateral requirements, and these same requirements will guard the ECB in terms of its purchasing operations. But I tell you, the collateral policy is a disaster. Here we really had reduced the quality again and again and again at will, in order to allow the banks to scratch out of their balance sheets again more assets which they could hand in as collateral. And the same collateral is now being bought. I think they absorb risk, and they carry out a fiscal policy which is no longer a monetary policy. And then when quantitative easing comes, they would also probably buy government bonds. And I repeat, thereby they would even do more than the Fed would ever do, because the Fed does not buy the government bonds of the States of America. It buys the federal bonds, but we don't have a federal system. I advise us to create the United States of Europe, then we can have a budget and so on. But we cannot anticipate the foundation of the United States of Europe by the ECB Council, a technocratic body. This requires a decision of the peoples of Europe. That is my fundamental point.
I think we need to finalize this conversation right now, because I can see the faces. You want to have another comment.
Yeah, sure.
And we haven't found any solution really. I think it's an imperfect situation right now, and I think there's a lot of need to figure out how to handle the different aspects of this very, very complicated crisis, from the financial markets to even the core of the ECB policy and the construction of the euro. Different layers that we have to set forward proposed reforms, and even structural reforms is a very complicated matter. And also in France and other countries, it would be very difficult to move ahead. But I think there are possible solutions. There are several suggested here in the debate. But we'll have to move on and to stretch our legs, to get a bit of coffee, to continue the conversation, indeed. And afterwards, in 50 minutes time, we'll have a very interesting conversation with Robert Cooper and Karen Stockenberg Poulsen and Jonas Paller-Pester about the negotiator, about how to solve an international crisis, not only from Bosnia between Bosnia and Serbia, but as well between Ukraine and Russia. And we'll also have some small clips from the film, so you enjoy this very interesting documentary as well. So a quarter of an hour, and that will say 5 minutes past 3. Thank you.